All right, so you see a lot of YouTube videos about people telling you how to grow your account super quickly, trading Forex or crypto or stocks. I'm going to show you how I personally do it, and I should be one to talk. Here in my Telegram channel, I'll put a link in the description or in the pinned comment, but I call all my trades live, and this is the past 6 months of rolling P&L. And again, every single one of these trades is called live. Since the deposit about 6 months ago of $350,000, I've made $428,000 in realized profit. And then you subtract the swaps and commissions, which is almost 150K. And that leaves me with currently $630,000 in the account from a 350K starting balance, and it's been done in only about 6 months. Now, a lot of people will tell you that if you want to compound a $100 account to like $10,000, you have to do all these different things, and you also have to take a lot of risk, and they make it look like that's something that's likely to happen. What I want to tell you is, given 6 to 12 months of trading, if you can at least double your trading account and you can do it with controlled risk, that is the best way to approach it. And this works particularly well if you have two things that are true. Number one, you have a small dollar amount in your account. So let's say whatever is a small dollar amount to you. If you're worth $1 million and you put $10,000 into a trading account, a lot of people would call that a small amount. Okay, fair enough. If you only have, let's say, $10,000 in your bank account, and that's how much you're worth, and you put $100 into a trading account, that's a small account. Now, you can tweak the risk structure that I'm going to show you here in this video to whatever your risk tolerance is. But the two things that have to be true is that, number one, it's a small account balance relative to the amount of capital that you have. And number two, you just have to have a high risk tolerance. Doing this is extremely risky. But then again, we're not talking about getting 10 to 20% returns per year with nice, tight, controlled risk with 0.5% to 1% risk per trade, coming out on top 1, 2, 3 units of profit per month, and then getting to the end of the year in a nice profit, factoring on all the losing streaks and commissions and swaps and everything. What I'm talking about here is to actually take a small account balance and risk a lot of money per trade. Needless to say, this is super risky. Most people lose money trading. I myself have been trading for the past decade. Last month, it was exactly 10 years since I started trading back in March of 2016. And now we're in April of 2026. I've made millions of dollars in Forex and crypto and stocks combined. And in this video, I'm going to show you exactly how I do it. The basis of my trading approach has just revolved around something very simple, which I'm going to teach you right now. So when we go in here, you can look, this is one of my best trades of my trading career. It's among the top 3 best trades of my trading career. And it was just last week. I took one trade last week. It was a USD Canadian dollar trade, and I risked $100,000 on this trade. Normally I risk about an average of $50,000 per trade, but on this one it was a high quality trading opportunity. And so I risked a large dollar amount with a 1-to-1 risk reward ratio, and I was able to make this much profit. And I was able to do this on this account when it was $530,000. Again, now it's $630,000, and I'm growing this account to $1 million in total P&L. After I grow it to there, it will have grown from $350,000 to $1 million. And then what I'll do is I'm going to withdraw probably around $500,000. About $200,000 of that is going to be taxed based on my tax bracket here in the United States. And then I'll be left with around $300,000 in cash that's mine. And I'm probably going to go buy my wife a Lamborghini Urus Performante because that's what she wants. And then I'll have to make the $500,000 back, doing the same thing over and over again, rinse and repeat. So here's exactly what I do. Whenever I'm trading, I go to a chart, and you can do this with Forex or crypto or stocks or basically any market. But what you want to do is, instead of getting down here on the 15-minute charts and the 5-minute charts and trying to, draw little trend lines and see which way you think the price is going to go, what I want you to do is I want you to try this instead. I want you to go to the weekly time frame. Okay, and then what we'll do is we're actually going to go somewhere random here on the chart. And just to show you what I mean from like a very nice blank perspective. Right now I'm on a website called random.org. I'm just going to pick a number between 1 and 20. I have about 20 Forex pairs that I trade right here. So we're going to pick a random Forex pair using this little random number generator. And that's 7. So let's go to the 7th pair here. So 1, 2, 3, 4, 5, 6, 7. So we're on GBP NZD. Then what I'm going to do is I'm going to remove all the drawings here on the chart. I'm going to go to the replay mode, and we're going to click Start New. And then I'm going to go here and I'm going to click Random Bar. This is going to take us back somewhere random. This happens to be in May of 2005, so 21 years ago. And And this just goes to show that this works in any market environment. It's based on the same principles, okay? Super, super simple. Then what I do is here on the weekly chart, what's important to do is only focus on the most clear areas where price has bounced in the past, okay? So if we're gonna draw these areas where price has bounced very clearly in the past, we don't want to be using areas like this on the chart. Areas where price has gone past it multiple times over and over, areas where it's had wicks above and wicks below, and then it spikes above and back up below and goes above and then breaks it, and then it sometimes bounces, but then it comes back and then it just breaks below it. We don't want to be using areas like this on the chart. What we want to focus on is we want to focus on using areas on the chart where prices had very consistent bounces over and over and over again. Okay, so for example, something like this would be really nice because the last time price was there, it had a nice big bounce away from that region. Another area, if we go and look at where current market price is we have price bouncing right here along these highs. So far, at least over the course of the past few weeks from when this is here, right, from December of 2004 to May of 2005, so it's about 4 or 5 months, every time price has been in this region, it has bounced up, it broke below, found resistance a bunch of times, went deep into the resistance zone, but still bounced and fell away. So something like this would be a really good area to trade off of based on where current market price is. It's not important for you to go to current market price and then draw like a zone like way over here. Why? Just because on a weekly chart, it's going to take forever for price to get there, and then price has all these other zones it could bounce at before it gets there. So there's no need to draw zones that are really far away from current market price. The other thing you can do is you have one zone above price, and then you find the next clear zone below price. An important thing to point out here, if the market's really trending hard in one direction, you may not have a recent zone of support if price is going in a downtrend. And so what would you do in this case? You would just draw the next resistance zone above price, and then if price gets there, cool. If it keeps going lower, that's cool. We don't want to be taking any trades where there's not a clear area where price is bounced. This works really, really good whenever price is kind of like in a steady state flow, meaning it's just going back and forth. The Forex market is pretty efficient and price ranges quite a bit in a lot of these Forex pairs. A lot of people say it ranges 70 to 80% of the time, and then only a small percentage of the time, like 20, 30%, is it actually in a clear trend where it's going in one direction. So whenever you're doing this, you're just looking for areas where prices have bounced very, very clearly at. So here's what we're going to do. I'm going to go ahead and just remove this 15-minute chart from my time frame and wash my hands of this. So I start on the weekly chart, and then what I do is whenever price is in between these two zones that I've drawn, I just set a simple alert at the next resistance zone, and I set a simple alert at the next support zone. And you can see me do this in my Telegram channel where I share all my trades. You can see me do it because the zones I draw are very, very simple. As a matter of fact, this USD CAD trade, I called it out in here. Let's go into here. I'll show you. So this was on March 30th, right? This is April 4th. Look at how clear and simple this is. That you can see it's a weekly chart on USD Canadian dollar. It's the only trade I took last week. And then what I do is I just draw the clear zones above and below price. So we have a zone here below price, but price is far away, so I don't even have it marked up. And then we have a resistance zone here. Price bounced as resistance here the first time, broke above, tested as support, went higher, came back, tested as support, went even higher, came back below, broke this zone, broke below, came back up, tested as resistance and fell, and then we came back here into the resistance zone. I don't want to try to make it sound like it's so easy, but honestly, that's how simple it is. I just literally go to the weekly charts and I draw the clearest support resistance zones above and below price, and then I just freaking wait. I just chill. I just sit still and I set the alerts and I just wait. I don't do anything until I get an alert that price has actually gotten into the zone. Now, a question a lot of people ask is, where exactly do you set your alerts here on these charts? Well, I'll show you. If you set your alert too far into the zone, you run the risk of price coming into the zone and then bouncing before it gets to the alert. And oftentimes price won't go super deep into these zones, right? It'll go about maybe halfway in or to the bottom, and then it will bounce. So setting an alert too high is usually not optimal. Another thing you might wonder whether or not you should do is setting an alert right there at the very beginning of the zone. Well, there's nothing wrong with this. However, the problem I find with it is that oftentimes price goes a little bit past that area. So it doesn't always go to the extremes of the zone, but it doesn't always just touch the first part of the zone and bounce immediately. Sometimes it does like it did right there, and sometimes it does like it did over here. It hit this region and then it bounced down and went very quickly away from the zone. But you're still going to have the times where price goes further away into the zone. So what I do personally is, this is why I just set my alerts about halfway into the zone. And you'll see I've already done it down here. How do you actually construct these zones? If we're starting from scratch again, Some people, what they'll do is they'll just use a line for support resistance. There's nothing wrong with that. However, I find it doesn't really encapsulate the most price action. So what I do is, whether it's a support or resistance, or it's acting as both support and resistance, kind of like this region in here, what I will do is I will pick an area where price has come into the zone. So say it starts getting in the zone right here, and then now we've got all these little wicks right here. So we've got some wicks here on the chart. And then what I'll do is I'll extend it out just a little bit. And then I'll start looking at where price action has been in the zone as well. So I notice a couple things here as price gets into these zones and starts bouncing really quickly down here. So I'm going to want to drag this just a bit lower to encapsulate that. Now we also have wicks pinning past the zone up here to the top. So what I'm going to want to do is I'm going to want to drag my resistance zone a little bit further up there to encapsulate that price action. Then what you get is you get these zones that are just a little bit thicker, and you don't treat them as an exact area, right? You don't treat them as an exact line on the chart where price is coming to an exact price and bouncing away. You treat it as a region where price could bounce. You never know which way price will go, and that's okay. That's why we use a risk structure, which is what I'm going to show you here in the next part. So when price gets into this zone, what we do is we just set an alert right there in the middle. And then when price gets here into the middle of the zone, the trade is fair to take. Okay, now I'm going to show you how I go to the daily chart and what I look for and what I examine. It's not complicated. It's just basic price action. There's no candlestick patterns. There's no Wagyu beef, bullish, order block, institutional, SMC, ICT, liquidity spike, candle entry strategy that I use. I don't use any of that. It's very, very simple price action. Basically, price comes into the zone. If it looks like it starts to bounce away, I just enter a trade. So we've got that zone up there. I'm going to redraw this one down here, and you can see I'm starting from where these candles close. I'm going to extend all the way down to that wick, and then I'm going to drag it further out this way. So that encapsulates all of this price action here with that wick, and it also encapsulates all of this over here as well. Price goes down in this zone, doesn't get quite as far to the previous low as it was, but this is enough to encapsulate all of the little wicks and the closures of the price action that came into this region. And then, again, I'll just go and set an alert here. When you're trading in the live markets, it'll be on the top. It'll say add alert to GBP NZD at that price. Since we're in the replay mode, it doesn't do that, right? Because you can't add an alert to the previous price action here on TradingView at least. But you can just draw this horizontal line, and this functions as a alert, right? So the lines are where the alerts would be placed. Then what I do is I wait for price to get to one of these zones. Now I'm going to show you exactly what to do step by step. What I'm going to do is I'm going to take it here to the daily chart. So we have price just going a little bit slower. And then we're going to wait for price to get to one of these zones. So as you can see, price got down here and it got halfway into this zone. And again, remember, I've randomly selected this, as I told you. I went to a random place, a random currency pair, and then a random place on the chart. It was literally from 21 years ago. So price gets here into this zone. As soon as it gets there into the zone, what I'll do basically, as long as price doesn't break the zone immediately, I will basically buy. Okay, and that's if it's at support. If it's at resistance, I'll do vice versa. I'll just sell. So what I will do here is as soon as price gets into the zone and starts bouncing, I will buy. So it gets to the zone. Let's say here on the daily chart, this is an entire day's worth of price action, right? Let's say it gets into the zone, it hits the alert, it lets me know price has got there, and then it starts to bounce upwards a little bit. So my entry might have been realistically like a little bit higher, right? Something like that after it had kind of started to bounce. Then what I'll do is I'll set my stop loss nice and clear below the zone. That's the first thing that's done, right? After you find the entry, you have to set the stop loss. So in this case, you don't want to put the stop loss too close because price can do stuff like this, where it just wicks past the zone or past the previous highs barely. So I find that having a tight stop loss doesn't usually work that well. I also don't find that it's useful to use a stop loss that's something like this, because if price is going to break the zone, it's invalidated. So you could get out of the trade much sooner. And if you're going to be doing that, to get at least a 1-to-1 risk reward ratio, your profit target has to be way up here. On the weekly chart, that could take months. I don't do that. Most of my trades last a couple days to maybe a week or two. And that is in practice when you look at my actual stats. Once you go to my Telegram channel, the link in the description of the pinned comment. You can go to my Telegram channel, you'll be in there in like the next 5 seconds. You can check all this out for yourself. You can see the pre-planning of the trades. You can see the trades I take, the ones I call out, the outlooks, the recaps, literally everything. You can see exactly how I do it. And most of the trades do, in fact, take a couple days to maybe a week or two. Backtesting here on TradingView has limitations, which is why I just use it to teach the proof of concept. And then all I focus on is just live trading, because live trading is the best way for you to tell whether or not someone can actually trade by watching them do it live in real time every day. So a sweet spot is not too close and not too far, but something like this, something where if price were to break the zone, you will know that the trade has become invalidated, and then you can just get out. So I'm going to put my stop loss right about here for this, and for my profit target, after I've done the entry and the stop loss, profit target just goes at a 1-to-1 risk reward ratio. Now, here's what you're going to do. The next part is going to be about the risk structure, and this depends on what your risk tolerance is. So let's say, for example, you have, say, $10,000, $20,000, $30,000, and you want to trade with about $1,000. It's a small percentage of your total capital, relatively small amount. If you want to grow that account aggressively, the reality is that you have to do high risk. Okay, now you don't have to do this. If you want to do 1% risk per trade, that is perfectly fine. I risk anywhere from 10 to 20% per trade. But again, keep in mind, I've been doing this for quite some time. A person's skill level and their experience is what really dictates the risk whenever it comes to something like manual trading. Trading is a skill set, and it's no different than any other form of gambling, like blackjack or poker. You have to know what the stats are, you have to know what the metrics are, you have to know what the probabilities are, and most importantly, you have to have applied experience. This gives you that kind of discretion and intuition to dictate what you're comfortable risking. So let's say on a $1,000 account, let's say you really want to do high risk. Again, this is very, very risky, and it should only be what you're comfortable with. So don't risk any more than what you're comfortable, like being willing to lose. Let's say you want to do 20% risk. Okay, so a $1,000 account, 20% risk, it's $200. Okay, so $200 for most people. If you're trading $1,000 account, and if you have access to like $10,000, $20,000, $30,000 of trading capital, and you only put $1,000 into an account, and then of that account you're only risking $200, the percentage, sure, we could call it high. It's 20%. Oh my gosh, it's so scary. But in reality, you're only risking $200 in this case, right? And again, this can change depending on whatever dollar amount you're trading with and your risk tolerance. But if we're doing high percentage risk per trade of this small account, what that means is that you can really put your money where your mouth is, and you can get into trades with an aggressive high form of risk, and you can grow the account quicker. If you want to risk 50% of the account per trade, that's fine. If you want to risk 1%, that's fine. You want to do 5, 10%, whatever. But you have to decide what is appropriate in terms of risk for you based on what you can afford to lose and what your risk tolerance is. And then also after you get some experience, whatever your experience level is. So I'll put my stop below, and I'll put my target up here at a 1-to-1 risk reward ratio. And I'm going to tighten this up just a little bit. I'll put this stop loss, take profit down here. Okay, so it's a 1-to-1 risk reward ratio. Now, on a $1,000 account, if we're risking 20%, that's going to be $200. So what you want to do is you want to make sure that you use an appropriate lot size such that if price continues away from this zone and then hits the stop loss, you lose only whatever it was you set to risk, in this case, $200. And then when you set your profit target, that means since it's a 1-to-1 risk reward ratio, it can go up to your profit target, and that will be about $200 profit. Now, you're going to have swaps and commissions and fees and stuff like that with any Forex broker. If you're using a regulated broker, the spreads, the swaps, the fees, commissions are probably going to be a little bit higher, but that's okay, because if you're trading on the weekly and the daily chart, the position sizing that you're going to be using to capture the amount of profit you're going after is generally going to be a lot smaller, and with smaller position sizing comes smaller fees. So that's great. Another thing about trading on the weekly and daily chart is the fact that you're not taking 1 million trades a day. And when I say 1 million, right, if you're day trading, you might take anywhere from 2 to 5, maybe 10 trades per day, or sometimes more if you're day trading. And if you're doing that and you're trying to capture a large profit on the smaller time frames, you have to use a larger position size, a significantly larger position size. And what this does is this means that you're just going to be paying more in fees, commissions, things like that. When you're doing this here on the weekly chart, you might be taking 1 to 2, maybe 3 or 4 trades per week, right? Sometimes there's more, sometimes there's less. There's weeks where I take 5 to 10 trades, like the week before this last one. And there's last week where I take only 1 trade, right? And you can risk however much you want per trade, depending on the quality of the trading opportunity, which you're only really going to get through experience. Again, this is why I trade live, so people can just see this over and over and over, and they can start being able to effectively just duplicate what I'm doing with their own risk structure and, of course, with their own discretion. So on this trade, we're going to risk $200, and then what we're going to do is we're going to play it out. We're going to see what happens. We're going to go candle by candle. So what would happen after we would have entered this trade is it would have bounced up into profit just a little bit. So it would have gone up, and this candle would have closed in profit. Now we're going to click to the next daily candle and see what happens. So the next daily candle comes back into the zone, and it's sitting there. So we're going to hold this. We're going to wait. The next daily candle comes down here into the zone. and it goes a little bit below our entry. And we're going to go ahead and remove this yellow line since that would have been where our alert is. The alert's already triggered, so it won't be on the chart anymore. So now it's basically just coming here around these previous lows. So remember, sometimes price will do stuff like this where it goes past the zone just a little bit, and that's okay. We just need to watch what price action does. So it starts to bounce a little bit, not really much going on. It's either going to break or it's going to go up. So in this case, it goes a little bit lower, then it quickly gets rejected there at that previous low and starts to go up. So I'll just adjust this zone down here just a little bit. We're going to see what the next candle does, and the next candle starts to go down. So a couple things you can do. The first thing you can do whenever you're first learning is just hold the trade to the take profit or the stop loss. When you're first doing this for the first few months, at least the first 3 to 6 months until you get profitable, I recommend just doing this on a demo account. And if you just have to use a live account, use a tiny percentage of your trading capital. Like if you got 10,000 to trade with, literally just put like $100 or $200 into an account and then risk, a high percentage of that account that you want. Like a $100 account, risking like 20%, that's $20. Okay. It's not gonna be the end of the world if you lose the account. So if you want to use a live account, fine, fair enough. I can't give you any advice or suggestions because I'm not a financial advisor. I'm just some guy on the internet telling you what he does and trades live to show you. So use a small account if you're doing this live. And if you're doing it in demo, use a dollar amount in the demo account that you would likely be trading live with if you were profitable and based on whatever amount of money you had. So if when you do this, you're going to start with around $1,000 account, just use $1,000 demo account. That way it keeps things as realistic as possible. So the first thing you can do is you can just hold it to the take profit or stop loss. I recommend you doing this when you're first starting, because if you just do that, something is true. Okay, now based on the statistics and data and based on me coaching over 4,600 clients over the course of the past, my gosh, it's been like 7 years since I've been teaching, like 7 or 8 years. What I recommend doing is just trading with a 1-to-1 risk reward ratio, letting it hit stop loss or take profit, because you're not trying to be profitable. You're just trying to get data and experience to start seeing what works and what doesn't. What this is likely going to mean is you're going to have around a 50% win rate. So half the trades will lose, half the trades will win, roughly speaking, given a long enough time horizon. And what that means is that long term, provided you're risking like low enough per trade, you're just going to break even long term, net of the fees and commissions, because you of course have those if you're trading Forex. And again, they'll be smaller on the weekly and daily charts because your position sizing will be smaller because you're targeting a bigger price move. So you don't have to have as heavy position sizing to make the same amount of profit that you would using a high lot size on a small time frame, going for only 5 to 10 pips. You just don't have to worry about that here when you're trading higher time frames. So when you're doing this, the second thing that you can do is you can start closing trades early if it looks like they're not going to work out. And then you can lose a smaller amount of money when you're wrong versus the amount of money that you'll make on average when you're right. This is what I personally do when I'm trading. Most of the trades when I get into, if they start going sideways, or they don't look like they're going to bounce, or they're playing around the entry or taking too long, I generally just close. This means that a lot of my losing trades are actually somewhere around break even or small profit or small loss. And if they go against me, sometimes I'll lose a third or a half, plus or minus of whatever the stop loss was. So if I'm risking $50,000 on a trade, for example, and then it starts going sideways at the zone and then breaking the zone and goes halfway to the stop loss, then what I can do is I can close it halfway to the stop loss. And instead of losing $50,000, I only lose $25,000. But when I'm right, a very important thing is 90% of the time, whenever I happen to be right, let me just make sure I'm saying this correctly. When I happen to be right, 90% of those trades I will hold to the profit target. Okay. The realistic number, it's 80 to 90%. There's some cases where I'll close early based on the price action. But again, all this comes with discretion and experience and intuition. So what I personally do is I just close the trades early if it looks like it's going to break the zone, because it means that my average losers are smaller, remember, on average, than my average winners. And I'll show you how this all factors in. So whenever we go here on my Telegram channel, you look at my data, you can see that last week, this was 2 weeks ago, right? The week before this past week, I went on a losing streak right here, where if we factor in all these losses, so this was Euro GBP, which was one trade, NJ, which was another trade, AJ, NU, and GBP CAD. So this was a set of 5 trading opportunities. So Euro GBP is 1, NZD JPY is 2, AD JPY is 3, and then 4, and then 5. So it's 5 trading opportunities. But look at the average loss per trade, right? GBP CAD was basically a break even, right? It was $400 that I lost. NZD USD, I lost 5,000. AD JPY, I lost 5,000. NZD JPY. On these two trades combined, I lost about, let's say, $10,000. Euro GBP, you can see I lost basically 8,000 times 3, so about $24,000 on that. But then when I have winning trades that come around, for example, this Euro JPY trade, I won 10K and 10K there. That was a $20,000 profit. And then when you keep playing it out, given a long enough time horizon, you have stuff where your trading terminal looks like this. So this was that trade from last week, of course, but check this out. I had all these losing trades plus the ones further up, but then on the winning trades, I make more when I'm right versus what I lose when I'm wrong. USD CAD, 25,000, 25,000, 25,000. It was a $100,000 net basket profit. And so with this, it's very easy to make money long term, provided that you're just making more when you're right versus what you lose when you're wrong. So again, the two ways you can approach this is if price starts breaking a zone, you can close it early, or let's just put it in order. You can hold it to the stop loss or profit target just when you're getting started learning this, just so you can get a proof of concept, you can get some experience, you can see what happens, what trades tend to go to the stop loss, what trades tend to go to the profit target. And then once you get some experience, you can start picking out which trades are less likely to work and more likely to work. You can hold the ones that start to win, and you can get out of the ones early that start to lose. In the case of this example, we're just going to hold this trade here. We're not going to do anything. Okay, it's either going to hit the stop loss or it's going to hit the profit target. So I'm going to play this out a little bit quicker here on the daily chart. This one looks like it's probably going to break the zone, but then again, you can't ever predict what price is going to do. Okay, well, it actually hits the profit target. So, and again, this took quite a long time. Realistically, the trades I'm in, I don't remember the last time a trade took this long, right? This is May of 2005 to July of 2005. So May, June, July. So about 2 months for this to play out. This is, or I guess it's the 20th of May. So maybe like a month and a half to play out. Again, realistically, if you go back and look at my actual live stats from all the live trades, everything's timestamped there in the Telegram channel. You can actually see that like most of my trades, they take a couple days to maybe like a week or two. That's usually it. Like the past 6 months, I don't remember the last time I was in a trade on this account that I started, where every trade has been called live, where I was in a trade for more than a month. It's just straightforward. But in this case, it worked out, and this just kind of gives you the stats to kind of like get a feel for it. And remember, all we did is we just went to the weekly chart. We drew up the most clear support resistance zones above and below price, and then we basically just let things play out, right? So we've got a trade there that won. Okay, cool. Let's go pick another random pair. And in this case, we've got 18, so we're gonna have to do some counting here. So we know this is what, 7? So 8, 9. Okay, it's not gonna let me go through the replay. So let me go back here to the, let me exit the replay. Okay, cool. So we go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. So it's 80 USD. So we're here on the weekly chart. And what I'll do is I'm just going to clear all drawings. Look like the drawings are already clear for now. And then what we'll do is I'm going to hit daily so we can go back, and it won't take us like 20 years back into the past. Hopefully we'll go to start new replay, and then we'll select random bar. So this takes us here to September of 2025. So literally just last year. You know, not far away from where I started this account. So we're here on the weekly chart. We only got a couple more candles till it gets up to the current market data. So we'll see if there's any setups here. But what are we going to do? We're going to do the same exact thing that we would do for any other pair. So I see right here, I see a pretty nice clear support resistance zone here. And let's look at why this is a clear zone to use, because probably the most important part to this is knowing where to construct the zones. Okay. Also, in addition to that, the risk structure, but knowing where to construct the support resistance zones is very, very important, because the way that you do that is going to dictate the entry, the stop loss, the take profit, the risk structure, the dollar amount risk per trade, and using zones that are very reliable where prices tended to just bounce there over and over. I have no evidence to prove this, but I am utterly convinced that zones in the higher time frames just work better. They bounce easier. As long as they're clear enough, you have a lot of orders coming into the market right there at the zones, a lot of profit taking when price gets there, a lot of new orders getting in, like if price gets to a major support level, got a lot of people getting buy orders triggered, that price starts, gives it sort of bullish pressure where price can start bouncing up. I'm utterly convinced higher time frames work way better. The zones are so much more reliable, and it's just so much cheaper to be able to trade those zones, because you can use a smaller lot size and capturing a bigger movement, and therefore your commissions are lower and your profits are bigger. It's like a win-win-win in every way. So in this case, you can see that price came in here into the support zone, started to bounce one time, started to bounce a second time, came here and then broke. Now it came back up. We rejected as resistance 1, 2, 3 times, whatever you want to call that. Broke above, found support once, twice, and then very briefly here towards just the tip of the zone a third time. I don't even know if we'd call that a third time, right? Let's just call it 2 times very, very clearly from right here. Then we went up higher. So that's a pretty clear zone. Now the next resistance zone above price, I see this right here. So again, I'm going to start here. Let's start it real nice and slow. We know that in this general region, price is bouncing around these little resistance areas, right? We know that around those previous wicks, price has been bouncing, but we still have to get a zone that's tradable. So I'm going to start here where these wicks are. I'm going to drag it out just a little bit, and then we're going to see, okay, price bounced here and here and here, but then we also had it kind of go a little bit deeper up into that region. So we want to include that data. You know, we're very inclusive here whenever we're trading. We need to really include all the wicks that go past the zone. So we're going to include that little wick right there. Cool. So now what are we going to do? We're going to set an alert right here at the very bottom of the zone before price gets into the zone. Did you catch that? Okay, cool. If you did, sweet. No, we're not going to do that. We're going to go halfway into the zone. The alert gets set halfway into the zone. Not towards the tip of the zone, not towards the bottom of the zone where it first starts, but about halfway into the zone is reasonable. And you can see about halfway in here, that's where most of the price action is anyway. We just had this one little wick past it. But other than that, we've got all these right here. Cool. Same thing for down here. We're going to go about halfway into the support zone. Draw a horizontal line. And in this case, again, you'd just be using an alert in real market data. It's just the first option on the top. And then what we'll do is we'll just wait for price to get here. So I'm going to go to the daily chart just to slow it down a little bit, break it up into more candles. And you'll notice, you know, you don't get a lot of trades all the time, right? You're still going to have plenty of trading opportunities because you got 24 Forex major and minor pairs to trade. I trade about 20 of them. There's a couple CHF pairs I don't trade, like NZD CHF and CAD CHF and Euro CHF. But aside from those, and there might be a few others, I trade all of these that you basically see right here on the right side of the screen. So you're still going to get plenty of trading opportunities. You just have to be very selective, and it's okay if trades take a long time to set up. There might be pairs where sometimes you don't get a trading opportunity for, you know, like 2, 3, 4 months or more, and that's okay. We don't want to be rolling the dice on anything because there's plenty of good trading opportunities. So we got this alert here. I'm just adjusting it to make sure we encapsulate all those highs. So we might be coming to the resistance zone. Let's see what happens. Okay, so price does in fact get into the resistance zone. This is January of 2026. Now what we want to do is we want to see if this candle starts bouncing. You don't have to wait for a daily candle close. You don't have to wait for a weekly candle close. You just want to see that price has gotten into the zone and then it starts to bounce away a little bit. That's all. That's all the price action you're looking for. It is not complicated and there's nothing specific. You have to get out of your head black and white thinking. There's no right or wrong in trading. There are no absolutes. There's no certainty. All you have to do is you just have to use like 2% of your brain to say that whenever price gets into a zone and then slowly starts to bounce away, that what you can do is you can start getting into that trade and you can start participating in it because price is coming to a zone and it looks like it's starting to bounce away because price has gotten into the zone and then starts to fall. Very, very simple. Takes a little bit of experience to get used to, but again, that's what my free Telegram channel is for. You can go in there and you can watch me do this every single day. So let's see if we get a candle that starts to kind of go to the downside. So it doesn't happen on that first candle whenever price hit the alert. Price just kept going up, but now we have another daily candle where we've gotten here into this zone, and then it hits, it looks like the very top of the zone where that previous high was, and then it starts to go down a little bit lower through here. So we have it starting to reject right there. So let's go ahead and remove where the alert would have been. Let's go ahead and adjust the zone just a little bit higher to encapsulate, you know, we're still encapsulating all of these, but we're just being a little bit more precise now. And then what we'll do is we're going to structure a trade. Now, first thing you have to do is you have to find the entry, right? The entry is just after price gets into the zone and starts bouncing away. So in this case, the entry, let's just say it was there on the daily candle closure. Perhaps if you can catch it beforehand, you could enter a trade and then it starts getting there before it closes. That's great. So in this case, we have price starting to bounce away from the zone right there. We're not going to put our stop really close like that, but it also doesn't need to be way up here. Really, when price starts breaking past the zone, that's when it's invalidated. So instead of putting it way up there or way close to right here, we're just going to set it right there. Okay. So in this case, it's about 107 pips of potential loss. Then what we're going to do is we're just going to set a 1-to-1 profit target. And now we just have to decide what the actual lot size should be. So let's say, again, we have that $1,000 account and we're risking, let's say, 20% of that. 20% of $1,200, let's just call it, let's say $250. Let's just, nice and simple. We'll just say it's about $250. So what we're going to do is we're going to enter this trade, and if we're right, we'll make a profit, and if we're wrong, we'll lose the money. And in this case, we're just going to hold it to the stop loss or the profit target. I'll still give my little narrative and annotations and explain the context and stuff and what I would personally do. But when you're first doing this, I just want this to be very simple for you, because it's so much easier whenever you're able to just hold the take profit or stop loss, knowing that long term, given enough trades, of course, like at least 50 to 100 trades, perhaps even a little bit more than 50 to 100 trades, you just need to make sure that you're getting enough data to see what happens, and you're probably just going to break even. So there's no real loss except for your time commitment. And again, that's generally speaking, okay, given the stats. So with this, we're going to risk $250, and that means that you'll just have to use a lot size such that whenever price goes up here to this price up here, it's about 100 pips away, 107 pips away, that you're only going to lose whatever dollar amount it is you decided you wanted to risk. So make sure you're using an appropriate lot size. There's plenty of lot size calculators out there. I'm sure there's plenty of other videos here on YouTube where you can learn how to structure the risk appropriately, and then you can get into there. Cool. So risk $250 per trade for this trade. And then we're going to let it play out. So I'm going to zoom in a little bit closer. We're going to click forward here on the daily chart. We're going to watch what happens. So the first candle just spikes straight above the zone, and then it goes almost to the stop loss. So this is one that's almost certainly going to hit the stop loss based on what's happened here. So we'll click forward, and then it does in fact go and hit the stop loss. Now what we'll do is, since price has gone to hit the stop loss there, let's see, when is this? February of 2026. We're getting very close to current market data, which is right now. We do have another resistance zone up here. So what we would do here is we're going to accept this loss, right? So $250. Now the account is down to $950 from a $2,000 deposit because we won the first trade. Now we've lost this one. What we'll do is we'll set an alert right there, and the alert will be about halfway into the zone. I'm going to put it near these little wicks where price went into there. I'm going to wait for price to get there, and if it gets there, we're going to look to sell if it looks like price is going to bounce. So it looks like price did in fact get there. Let's see what's going on right now, because this is February, so we might be able to have this play out. Again, we're in April of 2026 right now, so this is like, basically almost 2 months ago. So what we'll do is we're going to sell. Again, it's basically going to be the same type of trade, right? We've got an entry there at the zone. Price has gotten into that weekly zone, and then on the daily chart here, we waited for a little bit of rejection, so we're going to enter right there. We can remove this little line for the alert since it's already been hit. And then for the stop loss, let's I'm going to drag it just a little bit further. And then in this case, the take profit down here at 1-to-1. And we're going to risk 20% per trade, which is going to be, it'll be a little under $200 since the account's at $950. But for the sake of this example, we're just going to risk $200 just to keep it simple. Okay, cool. So we're going to click forward to play it out. So it starts to go into profit here on the daily chart. Ooh, narrowly misses the profit target. And then in that case, it does end up actually falling to and hitting the profit target. So now we've won this trade. So now the account was like 950. Now it's up to 1,150. So remember, the idea here is whenever you're starting is not to win every trade. It's just to collect data and get information as to like how things are working. So that way, if price looks like it's breaking through a zone or it looks like it's not going to work out, you can close early. That would have been the case here on this previous trade had you been watching it, because price would have started to have broken this zone and go above the zone very quickly. This could have been one where realistically you could have probably gotten out like maybe halfway to the stop, right? So right about here after it had clearly broken the zone and you saw the momentum coming into the candle. But again, when you're first starting and you're first learning this, that's just, it's, in my opinion, it's far too complicated for most people. At least until you get 3 to 6 months of experience doing this in demo or on a small live account, you can start to kind of recognize the types of price action and types of trades that look like they're no longer going to work out. And then you can just exit those. And guess what? If you exit those trades early, and then over the course of the next day or two, it looks like price is still going to be bouncing there at the zone and come back, you can always just re-enter those trades. There's nothing wrong with that. It is always better to protect your capital and control risk than it is to try to roll the dice on hoping that something's going to work out. Because as I'm sure you've heard many times, hope is not a strategy. If it's working, that's good. Hold it to the profit target in most cases, like 80 to 90% of the time. If it looks like it's not working, it's usually better to just close the trade, whether that's at break even or small profit or small loss or halfway to the stop. And then of course, from time to time, when you are using what it's called dynamic management, so it's just discretionary dynamic management in manual trading, where you're just deciding, should I close the trade early or not? That's all it is. When you're doing that, what you'll notice is it'll lower your average loss, and it also by default increases your average win if you're holding your average win to the 1-to-1 risk reward ratio profit targets. So that trade could have been closed early, but it is what it is. We lost that trade, but no, we won this next one. And again, this is getting close to current market data, which is right here. We're in March, so this is March. So if we wind this out a little bit further, you would see that it went up into the zone. It started to bounce again. That could have been another trade right there. So this one would have hit profit target. This one could have come up again. And then when it started coming up again right there, right, we could have had that wick starting to reject. You could have done this exact same thing. It's perfectly fine. You can enter again there and put your stop loss above, put your target below. The next candle went up a little bit above the zone. Again, this is why we don't use tight stop losses, because sometimes price will pin just past the zone. The wick will pin just past where the previous highs were. And then it closed with a little bearish wick, and then now it started going down below the zone and came down here. So in this case, this was like a trade that would have taken 4 days. From the moment you entered, it would have been 1, 2, 3 days. So we'll just round it up to 4 days. That would have taken 4 days. This other one here would have taken from February 11th up until 3rd of March, right? So this one would have taken like, 2.5, 3 weeks. So with that being said, this is how I trade. I have used support resistance zones in the higher time frame since about 2018. I started when I got profitable trading. For the first few years, I was using a different combination of this, and I was using kind of a different approach that worked for smaller capital, but it didn't really function well with larger capital. And then I found out that regardless of whether you have small capital or large capital, you just change the risk structure doing this exact same thing. And it is a strategy that has worked for me for the past decade. I can't really say that though, right? I can say maybe 8 years. The past 7 to 8 years using just support resistance with the controlled risk structure works. I've tested various risk structures, and I haven't found anything that seems to work better or simpler than just using 1-to-1 risk reward ratios and doing everything exactly how I showed you here in this video. So if this video helped you and you ended up hitting the like button, thank you. I really appreciate that. That helps the channel and makes me feel all warm and fuzzy inside. And I want you to go, for one, just make sure you're in my Telegram channel. Again, it takes you 5 to 10 seconds to join. A link in the description or in the pinned comment below. And then just go and scroll through that channel and watch what it is that I'm doing. Just go and scroll through all the trades I've taken, the trades, the recaps, the outlooks, and everything like that. I cover everything from A to Z in there. And it's showing you this exact thing that I'm doing, but it's showing you that on a daily basis there in my free Telegram channel. So I want you to do that. The next thing I want you to do is I want you to set things up exactly as I showed you in this video. If you need to watch this video again or certain parts just to help remind you about what to do, you can bookmark this video, meaning you can just save it to like your watch later playlist on YouTube, or you can just use if you're using Chrome or Safari, you can just bookmark this link here, above in your search browser. You can bookmark this link in your computer so that we can come back to this video if you need help to structure things again. I tried to be as comprehensive as I could without making it complicated. So teaching you exactly what you need to know and then nothing more, just so that way it's simple enough for you to get started. And I just want you to test this out. You can test it out through back testing, but just remember back testing does have a lot of limitations, and past performance doesn't guarantee any future results. What's going to matter is you just getting a proof of concept in back testing, or just scrolling through the charts with TradingView and looking at the exact same things I've showed you. And then once you start seeing that and you get a feel for it, then you can start doing this on a demo account, literally like this coming week. You can just do that. Like, you can test it out. You can start a new demo account with a small dollar amount balance or a small live account if you want, and you can test it out. I want you to test this out going forward. So those two things, just make sure you're in my Telegram channel because you can follow all this live for free. And then I want you to go and try this out for yourself, especially if you're a little bit new to trading, you've been trading for about a year or two, and if you're currently not yet profitable yet. I've not found anything that works better than this, and I think that if you try it, it might be able to help you make a lot more progress in your trading journey. Hope this was helpful. I love you all. Thanks for watching, and I'll see you in the next one.